Last month's non-farm payrolls report surprised the market with negative job growth, and that has put the Fed in one of its toughest dilemmas in years. On one side, rising oil prices driven by escalating geopolitical tensions are bringing back inflation risk. On the other hand, a rate cut could fuel even more inflation, while holding or even hiking the rates could increase recession risks. And with the latest FOMC dot plot pointing to just one rate cut in 2026, this week's non-farm payrolls report becomes the key, as the data reveals clues about the health of the U.S. job market and answers the question everyone is asking. Will it accelerate the Fed's rate cuts or force the Fed to hold rates higher for even longer? The report will be released on 3 April at 3:30 p.m. GMT+3. Stay with me as I break down what the data could mean for markets and how to trade around it. Before I break down the upcoming jobs report, make sure you subscribe to our channel and turn on notifications so you don't miss out on any market updates and insights. The February NFP dropped a surprise in the market with an unexpected decrease of 92,000 jobs, while the unemployment data rose from 4.3% to 4.4%. The wage growth, however, exceeded the market expectations, with the average hourly earnings increasing by 0.4% month over month and 3.8% year over year. Despite the NFP shock, the US dollar index was supported by safe haven flows as geopolitical tensions continue to escalate. Conversely, gold initially surged on the NFP weakness, but later retreated as the US dollar gained strength. On the other hand, all three US stock indexes were down, while the oil prices continued rising due to the Middle East conflict development. To trade around the NFP release, you've got to watch the forecast numbers. Comparing these forecasts to the actual data gives you a clear picture of where Forex, commodities, and stocks could move. The upcoming March NFP is expected to rebound from the decline in February and show an increase of 55,000 new jobs. On the other hand, the unemployment rate is projected to continue rising from 4.4% to 4.5%. The wage growth is also expected to be slower than the previous NFP report, with the average hourly earnings increasing by 0.3% month on month and 3.8% year on year. So how could the market react to the NFP report? And what should traders watch out for as volatility kicks in? In a moment, I'll break down three key assets: the dollar index, gold, and S&P 500. So stick around for the full technical analysis. Let's start with the US dollar index. The Middle East conflict has led the dollar to surge and rebound to above the 100 level. If the NFP report exceeds market expectations, the dollar could strengthen and continue surging to the 101 level, potentially testing resistance at 101.20 and 101.39. Conversely, a weaker than expected report may weaken the dollar, pulling it down toward support at 99.71 and 99.52. Now let's look at gold. XAUUSD has been under pressure as the yellow metal lost its status as a safe haven against the geopolitical tensions and has been hovering around $4,400 to $4,670. If the job report comes in significantly lower than expected, the gold price could rally and extend to the resistance levels between $4,910 and $5,030. On the other hand, a stronger than expected NFP could pressure gold and push it lower to support levels at $4,161 and $4,009. And now, the S&P 500 index. The index has dipped amid the Middle East conflict. A stronger than expected jobs report could lift the S&P toward resistance at 6,502 and 6,533. Conversely, a weak reading will continue pressuring the stock index and pushing it down to support levels at 6,237 and 6,207. That's the full breakdown. Remember, this is just my perspective on the market and not financial advice. If you find this useful, let me know in the comments. Hit the like button, share it with someone who needs to see it. And don't forget to subscribe with notifications on so you don't miss the next market updates.